go to this, and you're unmuted, you're now hot.
Okay.
Okay, so you're broadcasting to Zoom. What's up, Zoom? But when you're ready to mute yourself, switch. Shaka length is as far as you want to go. If you talk Portuguese like this, the microphone is very ineffective. Okay, so not too much Portuguese talk right around shaka distance from your mouth. These microphones are pretty good, but if you're way down here, nobody hears it. Okay. For everybody in the room, aloha, my name is Daryl. I am the technician. I'm running your Zooms. Have you ever watched the conference and like, what are they talking about? I can't hear anything. I don't hear the question. Irritating them. So this will be recorded. So if you guys hit the link, you can watch it back later. This is a desktop microphone. It is not required to come out right here. Okay? But what is required is that you press this button. Okay. So Zoom is now hearing us and it is now being recorded. It's like a little briefing. This is a desktop microphone. As long as you're holding the button and the green light is on, please be wary of that. Okay. Green light's on means you're broadcasting. You'll be able to talk to your Zoom compatriots. If you see a friend pop up, give them a shout out. That's fine. Actually, no, it's not fine. It's there. It's kind of their kuleana. But so the light's on. I'm muted. The light is on. And I'm now hot. I'm active. Okay. So we have here, there, not on that side. So because you just relay your question, and if you could repeat the question, if they don't do the microphone thing, I'm not going to come over the PA and scold you guys for not using your mics. Okay, but just be conscientious. Is that the word here? Okay. So, hello, welcome to just the pyramid scheme. All right. Have a good session.
All right. How's everyone doing today? You about to fall asleep from lunch? No? Okay. So my name is Adam Bell. I'm with ACB Logistics. This is a very important panel because as your business is trying to grow, you're going to hit points in time where you just can't scale without additional capital coming in. And these three individuals will help walk you through some of your options for that scaling. So either you're trying to buy a business, or you're trying to grow your business to the next level, or you're just trying to start out, or maybe go into a new part of the country or whatever. The information they're going to give you today is going to be extremely helpful. So I'll let you each introduce yourself, and then we'll go right into the questions.
Sorry. Do you guys have like a PowerPoint presentation?
Nope.
Okay. Thank you.
I'm not sure. Tech support. Oh, I was supposed to do this anyways. Hey, how many of you are just starting out? Like, okay. How many of you are already established, but you're wanting to scale? And how many of you are looking to buy a existing business? All right, cool. We did have handouts. I don't know if they got printed, but if you grab one of my cards, I have a cheat sheet for debt and business financing terms that I can send to you. So just grab my card, email me, and I'll send that your way. All right, I killed enough time.
Hello, hello. Is it
still
working?
good?
That's perfect. Thank you.
How about, is it working now?
Yes.
Okay, perfect. Good afternoon, everybody. Thank you for being here and thank you for having us. My name is Lalaine and I am with First Hawaiian Bank. I am at the Kahului branch. I have been a small business banker for almost 20 years. That is my passion and that's why I'm here today to help, small business to grow, expand, and be successful one day.
Hi, good afternoon, everyone. My name is Devin Vinoray, and I work at Central Pacific Bank, based out of their Kahului branch, but we have branches in Lahaina, Wailuku, and Kihei. I am a commercial loan officer at CPB, and I also kind of specialize in small business SBA type of products. We are an SBA preferred lender, so I'll be talking more about business plans and things later today.
Hi everyone, I'm Cassidy Matsuda. I'm a commercial banking officer at Bank of Hawaii. I do pretty much the same thing as they do, commercial loans, particularly commercial real estate. We can finance buying a business as well. That falls into my department. And for larger established businesses, connecting you with merchant services, cash management services, when you have larger deposit relationships, giving you the services to help protect the money you have in the bank, things like that.
Awesome. You can pass it down. She's the first up. So Lalaine, if you could be any type of fish. No. For
Dolphin.
entrepreneurs just starting out, what are the most important steps they should take to become funding ready?
Good question. How many of you here need money? Perfect. Right class. Well, let's talk about business application. The first thing you're going to be required to do when you come into the bank to apply for a loan is to fill out a business application. So to be prepared for that, you will need to make sure that you have your company registered. So if you're an LLC, if you're a corporation, you're going to have to register your company on DCCA website. So hawaii.gov. I think you can electronically, if you haven't done it yet, you can log on there and register it online. If you're a sole proprietor, you will be required to provide your GET tax license number. So make sure you go to the state, and I think you can request for that online too. So everything's digital now. You're also going to need to provide your operating agreements. If there's 2 members, the bank will want to know who is authorized to make a loan on behalf of the entity and who will be signing for the loan. Same thing with a corporation. You'll need to provide your bylaws. So a lot of times companies will, people will come to the bank and apply, but they don't have these documents in place. We will ask for that. So make sure you guys have that in place. And also when you're opening up your checking account or any kind of account, the bank will require that. Federal ID numbers. So if you're an LLC corporation, you'll need to request for an EIN number with the IRS. You can log in online also, and I think apply for that. And there's a 2-page document that you'll provide to the bank with it'll have your name and your EIN number. And you also need to provide your loan amount, right? So what are you requesting for? How much? And it's good to provide a breakdown of what the use of funds you're requesting for, because if it's for an equipment, we would normally structure that according to, the lifespan of the equipment. If you're buying a new business, you'll have to, probably provide a business plan with a breakdown of like, what are you buying? Is it just the assets of the company? How did they come up with the value of buying that business? So oftentimes we'll ask, like, did they provide a business valuation? Because there's different ways to determine what the value of the company is. Are you overpaying for this business that you're buying? What are you buying, right? So it's good to provide a breakdown of what that sale is. If you're looking to expand your business and it's for working capital line, normally that's for short-term funding, right? So it's normally an annual review, and the bank likes to see you to use that, pay it down, use it, pay it down. So it's normally paid by like your accounts receivables, and it's not a forever loan, right? They like to see that paid down on a short-term working capital. And then the other part of the application is, who are the owners of the company? Because the owner of the company will be required to provide their information as well as their personal financial statement. There's in the back, you'll need to, fill out the assets section, what kind of liabilities, and what the bank looks for in there normally is what kind of liquidity do you have for capital injection, right? So if you're buying a business, normally the bank won't finance 100%. They'll want you to put in your equity in it. You know, they want you to have your some game in this so that we're not taking 100% risk. So where is your source of capital coming from? So they'll probably need to verify that. And then for existing companies, if you
Oh, that's going to be our next question series.
oh,
So,
okay.
all
Yeah, so he was
So-
gonna go over.
yeah, Devin, can you talk specifically about startups and SBA funding for startups?
Yes, yeah. So, you know, Lalaine talked about like the kind of basics, like just as an overview. And so when it comes to startups specifically, there's kind of some supplemental information that banks would like to look at. And one of those things is,
It's on, but it's only being used for Zoom, not for the room.
sorry, I'll speak a little louder. Oh, that's okay. We'll do our best. So, as I was saying, so some of the supplemental information that the banks will ask for is a business plan for a startup. And so typically what that means is, I mean, you could spend hours making a business plan. You know, some people just write a one pager. I mean, the SBA has their own templates online, and those are really only like a few pages long. So as much information and ideas you want to write down, organize into a business plan, that's typically what we kind of work with, and that's where we kind of start with, right? So and the other part of a business plan is a pro forma. So what that is, it's forecasting the next 24 months of your business idea, you know, as you plan to operate it in your head with like revenue, expenses. If you're selling a product that you have to kind of buy ingredients for, right, the cost of that to make your product, you know, kind of the operational stuff, in addition to like what Lalaine covered, right? So like the DCCA filings, all of that type of, you know, paperwork side, like legitimizing your business.
Cassidy, can you talk about a new business owner, like they're not really even all that established, but they're wanting to buy an established business?
So when buying a business, purchasing a business, the first thing you want to know is what is the purchase price and what are you buying? So for your seller, asking them what does the purchase price include? Is that inventory? Is it real estate? For a doctor, maybe it's the client book. What are you actually purchasing? And how did they get to that number? Down the line, if bank financing becomes an option, we're probably going to require what's called a business valuation, which basically double checks that the purchase price that you're given matches what you're buying. And then the second thing that we need is the financials of the existing business, which can be difficult to get from your seller. They don't want to show you their financials upfront, but it is what the bank is going to look at to rely on how you're paying back the loan. Another tip is if you already have an independent salary, a job, holding on to that job for the first year or the first couple years while you're starting up that new business, because the bank can rely on your salary aside from the business cash flow.
Awesome. Devin, now we're going to move into existing businesses. They're already established. Now they're at like a pain point for growth. What is different about an existing business as opposed to a startup when it comes to seeking funding?
Yeah, so I guess what an existing business would have is just more of a history of record, right? So like your DCCA is established. Typically, a startup is a DCCA that's less than 2 years since it was established. So that's just a hard kind of line in the sand. The other thing would be like, you know, you have historical tax returns, company prepared statements, you know, balance sheet, income statement. We do look at like a business credit score, which is kind of coincides with like what the personal credit score would reflect. But the business credit score maybe takes into account more of like the industry, the NICE code of your business. Just a small variation to it. And so I'd say the kind of main thing that we look at when we look at a startup, it's, I kind of say, like, I'll talk to anybody about anything, whatever you got going on, wherever your business is at. I try to, at least if I can't find the right financing option for you, at least I can kind of give you my opinion and hopefully add some value there. But the kind of few things that we look at just off the bat is going to be, skin in the game, right? Having, your own equity, like a down payment in a sense with real estate, how you look at it like that, but also, kind of what Cassidy was talking about with buying an existing business. If we're not going to finance 100% of something, it's important to have, maybe other outside income at first, but the story that you can kind of explain in your business plan is like, this is how, I expect phases to change as I go forward. Right. And it's a business plan. It's not a crystal ball. So it doesn't have to be, if things change, but you said it's going to happen this way, it's not to your fault at all. That's like something that I think people worry about, that like really from our perspective, we don't look at it like that at a bank. So that's kind of the main things, I guess, between a startup and a existing business.
Okay. Cassidy, you talked about buying an existing business as a startup. What is different about being an existing business, buying another existing business?
Being an existing business, buying a new business, that gives the bank two cash flows to work with. So the number one question that the bank has for you when you go in for a loan is, how are you going to repay it? And usually that's the cash flow from your business. So if you have an existing business, we can leverage that for the purchase of your new business. Same thing if you own real estate, we can leverage your real estate, cash out on that, to purchase the new business. So usually when you come in for a request, banks want to look at everything, what you have in a business, what you have personally, what you're looking at purchasing. We look at the whole picture to kind of understand what options you have, because what you come in wanting to do might not be what we end up doing, just based purely on what the best creative option might be.
Okay, awesome. Lalaine, can you talk to us about the overall process and what an existing business needs in order to be ready for capital funding?
Can you expand on that?
Well, I think you have all the answers on your sheet. I can see it from here. So just go through your answer there. What you covered for startups, but doing it for existing business would be perfect.
So what
Yeah.
you need to provide when you come to the bank?
Yep.
Okay. Yeah, so we would probably ask for 3 years of your business tax returns. And why 3, right? 2020, COVID happened, right? So most businesses were probably affected significantly. So your 2019, you're probably doing really well. Then COVID hits, like everybody got shut down. So you're going to see a significant decrease in your sales and your net income. 2021, 22 came along, and then you got hyperinflation, and things came back to business. So you can see a better year in 2021 and 22. And then the fire hit in 23. So you'll see a cyclical, right? So when we look at cash flow, we like to see, what the trends were, what happened, so that you guys can explain like, hey, this is what happened. This is why sales decreased, but this is what we did to improve sales. So if you are showing a loss on your tax return and to justify that, like, hey, this is what we're doing going forward, and this is what we need to be able to expand, it's good to provide a projection for the next 3 years to show like, hey, this is what we're doing to increase sales. Maybe you're going to expand or diversify your product. These are the expenses that we're going to incur because of the additional expansion and what your bottom line is. So cash flow is really key. And just because you did really bad during COVID and the fire, right? You can always justify that this is what the economy is doing today, and this is what we're doing to increase our sales so that we can, continue to do business.
Awesome. Thank you. The next 2 questions are going to be a little bit more open-ended, free-form questions. And then we'll open it up to you all to ask your questions. So Cassidy, what are common mistakes or misconceptions entrepreneurs have when approaching banks or funding institutions, and how can they avoid them?
So one common thing I hear in the bank is, I need money for my business. I need it for working capital. I don't know how much I need. Can you just tell me how much you can give me? That usually tells me that you don't necessarily know what you're doing or your business is struggling. And like in Isaac's talk this morning, when you get a bad food review, it's already too late. It's the same thing. If you're in a hole, it's already too late to get a loan. So we want to hit you in the point where our loan is used to sustain or grow your business, not to bring you up when things are already down. So I would say being specific with your ask, why do you need a loan? What is it going to be used for? Tell your lender exactly what you're financing. Do your homework, be realistic. If you're doing construction and you think something is going to cost $100,000, it's probably going to be like 2 or 3 times that much and take twice as long. So understanding that and being able to bring that in shows us your confidence and experience. And knowledge in your company, which is super important.
Yeah, so it needs to be a strategic plan.
Yeah.
Yeah. I think it's Lalaine's. So same question, and again, it's open-ended. So what would you like to add to that?
So for companies that are purchasing a new business, for example, and we're talking about cash flow, if the company that you are purchasing has the historical, that's good because you have an idea of how they did, right? And if you're going to change something about the business and what are you doing to improve those sales and what you're doing to minimize costs, for example, and this is what you're gonna net. So that's a good way to provide to the bank, because it's, even though you're buying an existing business, you're considered a startup. So you would also need to provide some kind of a projection to show like what changes you're gonna do, and this is what my bottom line is to repay back the business.
Actually proving that they're a business owner and they're ready to be a business owner, right? Yeah. Devin, what would you like to add?
I guess kind of just a few points from kind of what you both were saying. What we do look at, like the cash flow as like the primary source of repayment. So, the timing of like seeking financing when your financials look good, even though you don't maybe need a loan at that time, but maybe want to shore up some access to capital, that can be, more strategic than kind of looking at, oh, I need to go to a bank because that's like one of my few options left. Everyone's case is different. It's hard to kind of speak to generalize it all, but just, I mean, and the other thing I guess would be like the SBA is, we call it a credit enhancement. So it's not so much like, oh, I want to get a loan. Oh, if I get an SBA loan, those are like easier to get, or, the programs kind of coincide with like your business financing request. That kind of has to match first, right? That has to make sense for the bank first before we would explore like, okay, well, this would make even more sense with an SBA guarantee. So for example, during the pandemic, people that had SBA guarantees on their loans, basically the SBA paid their monthly payment for like 18 months. And so when that went away after the pandemic, if you had a 5-year loan, you only made payments for like 3.5 years of that, And so there's a benefit to you with the SBA guarantee, outside of, extreme circumstances, but, you want, it's more of a partner than like just like kind of, I don't know, makes it easier to get access to funding. So
Lalaine's next on here. This is our final preset question. Beyond traditional loans, what are other creative or alternative funding sources which small businesses should consider, and what are the pros and cons to them?
So who likes free money? We all do, right? Yeah, have you guys heard of grants? There's a lot of grants available out there. You just gotta look for it. So you'll see state grants, there's federal grants, but these are, some of these are like specific to a project or specific to, based on the requirements. So it's free money, but you have to meet the requirements, and because it's free, it's very competitive, right? There's also nonprofits that offer grant monies, and MEOs, business development, they offer a class every year. I think there's like 4 or 5 classes that they offer in person, online, or I think mix, where you put together a business plan, and at the end of your course, you pitch your business plan, and they actually provide grants to startup companies to help them with their startup companies. So there are resources out there. You just have to take the time to take the class and put in a solid business plan to convince the judges to you know hey, this is a viable business and this is why I should get the money. For some people may not qualify for a traditional conventional bank loan, and so there are microloans offered out there, and there are MEO, for example, also offers microloans. So same thing, you would be required to put together a business plan, and microloans typically it's nothing more than 50,000. So it's capped, I think, at that. And these are more for people who are like startup, right? You don't necessarily qualify for a conventional because you don't have 3-year historical. So for startup companies, it's hard to get a traditional loan. So you can apply for a microloan for people that don't meet the credit score, for example, because one of the criteria that we look at the bank is credit, right? If Are you guys aware of what your score is? Have you guys pulled it up recently? It's good to check your credit report before you apply to the bank. That is my advice to you, because I've seen people come into the bank, apply for a loan, their business plan is like flawless, but their credit score didn't meet the guidelines. So if you have any delinquencies on there, bankruptcies, charge off, it could adversely affect the approval of your loan. The bank can deny it. And I've seen that happen. So, and there's some that have come back and say, that's not mine, oh, that was a mistake. So now you have to call your creditor and dispute it. You have to contact, so there's 3 credit bureaus that you can contact. There's Experian, TransUnion, and there's Equifax. They all share the same information, and as long as you contact one of them, you can dispute it online. You can write to them, but I'm not sure of the response, if it's going to be right away. So that could hold up the process of your application if you don't resolve that right away. So my advice is check your credit report annually. There's a website called annualcreditreport.com that you guys can log into to just check the history. It won't give you the score. I think you have to pay for the score, but you can pull it up without you triggering it as an inquiry, right? As compared to when you come to the bank and you apply for a loan, every time you go to a bank and apply for a loan, it's a trigger. So when you apply to many institutions at one time, that could adversely affect your credit score. So you don't really want to do that. So, right, check your credit score before you come into the bank. And that's
Awesome.
nutshell.
Thank you. Devin, what are some other alternative sources that you can think of, or additional advice that you want to give?
I guess sometimes when bank financing doesn't work out, and kind of like what Cassidy said, you try to work with your banker to get find the right, maybe creative structure, that kind of works with the holistic picture, not just your business and then, the personal side is separate. It's kind of, we look at it holistically too. So sometimes maybe hard money lending is, an option for you. We don't really lend on asset lending. There's other institutions out there that do that. I'm sure QuickBooks will market to you take our loan and you'll get approved, and it's 30% or something crazy. But if you need it, sometimes it's easy to click for it, and then your problem kind of goes away for a little bit. It's tough, but I think when you go to work, when you walk into any one of the branches and you meet one of us and you talk with someone, I think you're going to get the sense that we don't really know all the answers, but we want to work with you. We want to, we're learning as well, right? So it's if you have a question, well, if we don't have the answer, we're going to go find it. So like the earlier you can kind of start that process, maybe more beneficial to you than waiting to, waiting to make it more perfect on your end or something like that. Because maybe that, maybe it's perfect already, or maybe it's ready to go. So
Awesome. And then Cassidy, you're finishing us up.
Yeah, so how many of you own your home or have equity in your home? So if a customer comes in and can't qualify for bank financing, one of the first things we ask is, do you own your home, have equity in it, and can you get a HELOC? So when you're first starting out, essentially you're your business. It's probably you, maybe you and a partner. A HELOC can be a really good alternative for funding. It has good rates because it's a secured loan. You have a longer repayment term. If you're trying to buy equipment, usually the term is 5 to 7 years, but with the HELOC, they can extend that out for you, things like that. The biggest con, and I know we're all thinking it, is why do I want to pledge my personal collateral? But you're your business, and if you believe that much in your business, you're going to do that to get the funds to start off. So if you've ever heard of the book Shoe Dog, it's the autobiography of Phil Knight, the founder of Nike. When he was first starting off, he got a bunch of bank loans, and it eventually came to a point where everybody cut him off, and they said, "This is risky. Don't do this. We can't do this for you anymore." And his last option was to pledge his loan. Pledge his house to get a loan. And that was like the last big loan he got before Nike like took off and became what it is today. So it's a really good option, especially for starting off. It might be the easiest route and something to think about.
Awesome. All right, so now it's going to be open questions, but before we go into that, just a few things that I heard consistently is this should be part of a strategic plan, not an emergency run to the bank and try to get money thing. So you want to really do your research, really put in a good plan. And honestly, you should be doing that anyways, because this isn't a tool to get you out of trouble. This is a tool to help you grow and expand, right? There's one important loan mechanism for businesses that I just don't want to forget about. And so my question is, when it comes to buying commercial real estate, either as an investment property or your primary point of business, is there anything in that any of you on the panel want to talk about that might be a little bit different than like the business loan that's more traditional?
I can start off with traditional financing for real estate, and then maybe Devin can talk about the SBA route. But the first thing is 25% down payment on the unit that you're wanting to purchase, and then 2 to 3 years of stabilized cash flow are the two biggest things the bank will look for. And to gauge when you're ready to purchase real estate, once you have a bit of a down payment, ask yourself how much you're paying in rent. So a couple weeks ago, I helped a couple close on a base yard. They were renting for $10,000 a month. And then their mortgage payment is now $6,000 a month.
Mhm.
So if you can pay that much in rent, you can probably pay a mortgage. So something to start thinking about when you're renting is, how am I going to get ready to purchase?
Yeah, and that's one of the reasons why I didn't want to leave that hanging, because that is a potential cost savings. It doesn't feel like it, but it could be a cost savings to what you're currently doing, because then besides property tax, you're going to be paying the same amount for the next 20 years instead of the escalation. And the escalation can be anywhere between 10 to 50% year over year. So it can get away from you really quick.
So there's also the 504 HEDCO loan program. So instead of doing the traditional, which will require more down payment of at least 25, if not more, depending on what the credit looks like, 504 requires only 10% down. So that's one of the pluses of going with this program. But there's also requirements. So if you're going to do a HEDCO, you will be required to occupy the property of at least 51% of the facility. HEDCO will finance the 50%, the bank finances the 40%, and you guys will have to put down the 10% down payment. So if you don't have the cash, this is a good option as long as you meet their guidelines. The other positive thing about Headco is that their rates are normally higher, lower than the bank's pricing, and they can lock it for a longer period fix. So the on the bank's portion, the 40%, you can lock it for 5 years, right? It's a 10-year term. Or you can choose to lock it for 333, right? 9-year term. So depending on what the market does, right? The rates could have dropped. You could have closed your loan during COVID and you could have gotten a 3% interest rate. You're good, right? And you don't have to, that rate will readjust after that 3 or 5-year term. So compared to SBA's program, they can lock that for the 25-year period without the market volatility. So yeah, it's a good option if you don't have that 25% capital injection to put down as a down payment.
Awesome. All right. Questions? Who has them? Yes, ma'am.
In regard to pledging your personal asset as collateral, I just moved to Hawaii, so my collateral is in another state. How friendly are each of your bank would look into out of state real estate?
And panelists, when you answer the question, repeat it or summarize the repeat for the Zoom call. Anyone want to?
So I can't speak for the other banks' requirement in terms of collateral, but for First Hawaiian Bank, normally the property that we are doing a cash out on or doing a collateral, it has to be here in the state of Hawaii because it will require a lien recording, and if it's in another state, it's something that we don't normally do.
Is that similar for both your banks?
Yeah.
Yeah, I would just add that if you already have a mortgage on your property, maybe finding a bank in that state that can provide financing for it. And if you have a mortgage with an existing company, it's best to go with them to get your HELOC because you can get more when it's the bank that has the first lien and the second lien rather than two different banks.
That's a good point. Next question, Michael.
Hi, going back to business plans. I heard the word impeccable come up. What would be the elements that you would say would be an impeccable business plan? What do you look for in a business plan, and how does it weigh on the bank's decision?
And the question is for the Zoom audience, it's what makes an impeccable business plan to be loan ready? So who would like to answer?
Impeccable, that's a big word. I mean, it's kind of tough to say. I feel like that's like it's like saying it's like you're looking for a perfect business plan. Yeah, so
Yes.
the right elements would be like just a background, and then the management people like involved in day to day or just kind of the story of the business. And then like what we look at is like the numbers too, but it's like, how do we meld the story with the numbers and then, kind of in a sense, be able to then forecast out. Right. And so there's always going to be people poking holes at it, and that's like kind of our job to criticize it. And so, I think an impeccable business plan, in my opinion, would be something that whoever your audience is of the business plan, it helps them kind of form the right questions. And so then when you're in front of them, sharing your business plan or talking about your business that you're probably passionate about, the other person is asking good questions, and then you're kind of learning like, oh yeah, I should put that into it, because like I've heard this question from multiple people that I've shared this with. So I think that's how we use a business plan. The SBA kind of has some guidelines as far as like, just like kind of pretty boring, like, okay, they talked about this, like checks the box, you know what I mean? And then from there, once you have the basic stuff, you can then add like, other elements of your story in there.
So what I like to see when I review a business plan, if you are a key person running the business, it's good to put on there what your background is, right? So, hey, I worked for a construction company and now I want to start my own business. That gives me an idea, like you're going to a business that you know you've been in, and that's a strength, right? The other thing that we also look for that you should include in your business plan is your location, right? Like, are you leasing the place? How long is your lease for? Because that will matter. If you are leasing a property for only 3 years, we won't structure a loan any longer than what your lease term is. Because what happens after 3 years? The landlord may not renew your lease. Then where are you going to go? He could raise your rent, and your projected expenses could change, right? So it's good to negotiate that up front before you come to the bank, because you're gonna need to provide us with your lease contract. So that's one of my recommendations normally when I'm, just talking stories with a person like, hey, I want to buy this business. They're selling their restaurant. Okay, how many more years left do you have in your lease? Okay. Well, if you're gonna renovate the place and you're gonna spend $100,000 for 3 years, the landlord's gonna say thank you, because now you improved my place and I can rent that out after your 3-year lease, right? Are you willing to spend that kind of money to renovate the place if you only have 3 years left on your lease? You might want to negotiate an option to extend it for another whatever they're willing to offer. That way, what you're investing in, is for your business, and you have a place to operate your business. So that's really, really important. When you're putting together your projections, that's really important if you're a startup, because the bank relies on historical financials when we determine what your cash flow for source of repayment. The first thing I look at is, how are you going to pay me back? Right? How are you going to pay me back? So when you're putting together your business plan as a startup, it's good to do it in a monthly breakdown, so I can look and see, okay, how did you come up with your sales? Is your sales, is that like realistic? Or did you like just, wishful thinking? Like, this is what I want it to be, but what is the economy saying, right? What are your competitors pricing, and what are you pricing it at? And is that realistic? Like, will people pay a premium for your product, right? What kind of expenses do you anticipate for your business? And then you'll have your bottom line. So I like to see that broken up into monthly segment for 3 years, just to show that your growth. By 6 months, I'm gonna be, up to speed, and this is what I project. So
The more comprehensive they can be on those.
right, yeah, and it's good to explain that in your business plan too, so that when the underwriter looks at your business plan, they're like, oh, okay, I see how they came up with these numbers.
Awesome. The gentleman in the back there had a question with Michael.
So my question was more along the line of, if you have business credit already, do I need my personal information as well? I've got tons of business credit.
From Bank of Hawaii, we look at everything. So we would ask to see your personal financials, your personal tax returns, and credit score. But essentially, after we review everything, it'll determine whether you are required or not required to be on the loan. And it all comes down to, is the loan secured? What is that loan to value? And how strong is the cash flow of your business? But initially in review, we would ask to look at everything.
And just so you know, if you're on Zoom, I am looking at the chat. So if you also have questions, feel free to type those in. Devin, did you want to answer that, or do we want to open up to another question?
Oh, yeah, that was
Okay.
That was great.
All right. I saw you earlier. Go ahead.
I have a question. I can't think of how to formulate it, but I guess I'm at the beginning stages of, I want to start another business. And I've never gotten funding before. So I didn't know, like you were talking about the bottom line before, calculating your numbers.
Mhm.
Is there a certain percentage that when repaying the loan that we would factor in?
So you guys will factor in that the cash flow covers both the interest, the principal, and then has a hefty little left over, right? When they're projecting out their numbers.
Yeah, I think so the question was, if you have an existing business, and then you kind of, you have another idea and you want to kind of separate, like have a separate business, and kind of manage both at the same time.
Starting a new business venture, but I guess kind of like when you're looking at your finances and you're like, I should only pay like 30% in housing costs. Is there a certain percentage of the loan repayment that we should sort of stay under when factoring in like how much we would potentially make?
Sort of like a loan to value kind of.
Because I don't understand.
Yeah.
How do people get funding, pay off their loan and pay their
Life.
overhead and
Yeah.
make a profit?
Yeah. So I guess we have like certain bank policies. We look at the cash flow. So like, let's say I have a startup, and it's not really off the ground yet. So I'm not making any money on it. And then I have a separate job or income that's, there's excess savings that I have from that I put into my business. And so if I were to apply for a loan at that kind of stage, like, the cash flow will be combined as far as like my business as maybe losing money over here and then my other sources of income. And so similarly, you can kind of interchange the pieces where it's like, okay, well, I have a business here that's running and let's say there's income from there, or I have other income elsewhere. The bank would look at all kind of cash flows if it's positive or negative. And so ultimately the positive cash flow is what we would look at in comparison to like the monthly payments of a loan, if that's what the request, if what you're looking for is financing. So the ratio that we use, it's like a 1.25. And so what it is you take the cash flow, like if my cash flow is like $100,000 a year, and then like all the loans that I have personally and in my business, let's say my annual payments I'm making on loans, like principal and interest payments, let's say that is 50,000. So at the end of the day, after I pay all my bills, I'm bringing in 100,000. I've paid 50,000 in bills. So like at the end of the day, I'm left with like 50,000 like technical profit, right? So, my cash flow is double what I need it to be to service the debt. So, if it was break even, it'd be
1-to-1.
1-to-1.
Yeah.
Yeah.
If you ever need any help, it's a plug. Yeah. You can always reach out to ACB Logistics. We can help you kind of pre-math that and work it through. It's not super complicated, but the main thing is that your cash flow needs to be stable and healthy enough to absorb the debt payment without putting you at risk of bankruptcy. And might not be what you guys would need to look at, but I always recommend that you build into your scenario what happens if I get a 30% loss of business and a 50% loss of business. And really you shouldn't go after the debt unless you can still have positive cash flow after a 50% loss in your business and still cover your debt payments. That's what I kind of recommend.
So how we calculate debt service ratio is it's called EBITDA. So it's your earnings before interest, taxes, and depreciation. So when we look at your profit and loss statement, you have your net income. But if you have depreciation and you have interest on there, we normally add that back because it's non-cash expense. So that's added back into your cash flow minus all of your existing debts. So if you have a lot of loans, that could adversely affect your qualification for another loan. So the less loans you have, you can qualify for a higher loan amount. So that's something to look at when you're applying for other loans.
Awesome.
What's that no business one that I have? Actually, I don't have any.
Yes. So we base it on your net income, and then we add back your depreciation and interest. So based on that amount, and what you're applying, what your loan amount is, what your monthly required payments, that's how we calculate that service ratio.
All right. Questions? I saw several hands pop up. Yes, sir.
On an average, you guys said as lenders, you only lend up to 75% of what a person would be asking for. How could I guarantee that my loan would be that 75%? How do you guys know whether you will loan somebody, a business, 75%, 50%, 65%? What do I need to do with my business plan to guarantee that 75% funding from a bank?
It depends on what we're financing. So that 75% is typically for commercial real estate. That's more so the hard line on that. But if you're financing the purchase of a business or equipment, it really varies. And it can depend on your overall business health to determine how much we're gonna ask you to put in. So it's hard to say right now what it would be, but if you want to reach out and talk, I'm sure we can give you an idea based on your specific situation.
And follow-up question on that. Is there a standard that you guys follow to compare businesses and their health if they're good standing compared in the industry? Do you guys have a data sheet or standard whether you guys can tell whether a business is in good standing financial wise? Whether they're maybe in the middle compared to other businesses or they're at the bottom? How can you guys tell whether that business is going to be really good or not so good or all right? And then how would that affect?
So every credit is different, and that's where underwriting comes about. So we look at everything. You know, we don't just have this formula and say, okay, this is what it has to be, and this is what we will only approve, right? So first thing is cash flow. So if your net income isn't enough to qualify for that loan, you may have to put up additional down payment to bring down that loan payment so that you can qualify for that loan, right? There's also, so there's the 5 C's, right, of banking when we underwrite. There's collateral. Collateral, if your credit is riskier, for example, they could require that you know, add on additional collateral like your house, for example. And that may be required if you're a startup business because there's more risk with startup than an existing business that has been around for 5 years. Right? They look at the condition. They look at what's going on in the economy today. If you're starting a business and everything's shutting down like during COVID, right? What are the risks of starting a company that is related to tourism, right? It's high risk. So the bank could say, you know what, we can finance it, but you might have to come up with 50% down. So it all depends on what your credit is, you know, what your loan that you're asking for, what industry it's in. Yeah, it just depends on what your request is. So that's why we look at everything. You know, like I said, your credit also matters. So if you have a really good score, that's good. That's in your favor. But if your score is like a 650 and you had prior delinquencies on there, it's considered high risk. So that the bank could require more of a collateral because you're considered high risk.
Quick question, and then I think we have time for like 1 or 2 more. Can someone get like softly pre-approved or get kind of an idea for how much they can be approved for? Because some people will find a thing and then come to you with it already, I want to buy this thing. And some might say, hey, I want to have an idea before I go out and start wasting my time researching.
Yes, totally. If you have an idea of what you want to purchase, like real estate equipment, a vehicle, construction, if you give us all of your personal tax returns, your business tax returns, personal financials, we can generally see your cash flow, your debt, and what you might qualify for in a loan.
Because I think that would be really helpful instead of you going out and finding a $10 million thing and you can only get approved for 2, right? So,
yeah.
Questions. You had one, and then we'll get to you, and then I think we're done.
Okay, so like, on your working capital loans, yeah? Like, how does you guys, when you borrow the money from you guys, is it a set amount? Like, so if I borrow $5,000 and you guys have like a set amount of time, or is it like credit card action? Like, do you guys say, okay, you gotta pay $100 each month for 5 years, I can borrow back and forth on it? Or like, cause I do working capital through like PayPal. And I'll take money, I use them as a credit card services too. So they have their set as like, you know, 10%, 25% of whatever money comes in. So how do you guys like receive your money back if you do a working capital with you guys?
Right. So remember, working capital is for short-term lending, right? So you would normally use that money, buy your supplies, for example, or, you know, to buy whatever you're selling. And when you get paid back from
And
by your
how do you-
vendors,
How do I pay you guys back? Like,
right?
You guys, 25% of the money that I make, like
Mhm.
like you guys do the credit card stuff, and you take it out of there?
For-
Like that, or?
It would
Yeah.
normally be a lot less than
Yeah, so
that
you're
percentage though.
you're required.
Or is it a set amount for the short term?
Yeah, your required payment is based on interest only on what you pull out. So let's say you got approved for $50,000 and you only use 20,000 of that. Your required payment would be interest only the following month on what you pulled out this month. So if you only pulled it out for 15 days, how they calculate it is your balance that you pulled out times your interest rate by the number of days, and that normally gets billed the following month. That's when it's due. So it's interest only. And then when you get paid back by your vendors, you would pay down the principal, right? Because they want to see your repayment ability. They don't want a forever loan. So you should be able to show repayment back down to zero because you can always pull it out and use it again.
And what's like a running percent APR or whatever for capital loan?
It depends. So it's normally tied to the prime rate. So if that prime rate goes up and down, so a couple years ago it was like 8.5%, right? Today prime rate is what, 7.25%. So it fluctuates based on that prime rate.
Like traditional banks, because like PayPal does like a set amount
Mm.
for the loan, and then they take 25% off every time you make a
Yeah.
transaction.
Yeah, so yeah, they have different products. It depends on who you're borrowing
Well,
from.
no, They just charge you like $100, but then they want to make sure that they get paid back.
Yeah,
So every time
Yeah.
you swipe somebody, a customer's credit card, they take 25% of that transaction
I would
to repay.
be cautious of the PayPals and things like that of the world. A lot of hidden fees. You think you're not paying a lot, but you're losing a lot of money into that. And also, don't use.
The working capital one it's a set fee, and the 25% is just of each transaction that goes back.
Okay.
I was just wondering how, like,
And if you're living off of credit cards as well, guys, and stuff like that, please reach out to them and set up a line of credit and get off of that, right?
So I know what you're talking about, like the way the PayPal, like the payment processing, like credit line extensions work is they're the ones processing your payment. So like when you're so they're collecting 25% like before it even gets to your bank account kind of thing. So like the banks don't really do that, but it's like up to your discretion. So you could pay the line off faster, kind of like a credit card. Yeah.
Yeah.
So we wouldn't set it up to that extent. Yeah.
if I switch everything to one place, you guys don't actually do the merchant services, you guys work with other merchants, right?
Most banks will do a merchant service, and then
Yeah,
there's
we
also
do.
independent merchant services. That will be a lot better.
Yeah.
A
We're-
lot better.
Thinking like
Yeah.
consolidating all my stuff in one place would be.
So we are a local provider for merchant services, and one positive thing about local provider is that you'll get your cash quicker on a term basis, whereas like these mainland companies, they could hold on to it for like 3 days. I heard Square could hold on to it for 5-7 days, depending on how big that transaction is.
Yeah.
So if you're to batch your merchant service transactions today, you'll get it the next day for us. We can also compare your fees, but I know PayPal interchange fees are definitely higher than a traditional merchant service fees. Yeah, so yeah, we can take a look at that and compare, but I can tell you, yes, I've seen PayPal fees, they're significantly higher, and it's because of convenience, right?
Yeah.
So you pay for what you get for it.
But please get off of that stuff as quickly as possible. We are over time, but ma'am, I did promise you your question, so please go ahead.
Smart way to take your first business loan, and be ready for your next business, your larger business loan? Like, what's the smart way to do that? Do you start paying, does that next loan absorb your first loan? Would you write it into it, or do you start trying to pay more where that would be perfect? Does that make sense?
The general answer is every business is different and every business loan looks different. It's not like a mortgage where things fit in a box and it can be processed online. Like we will structure things individually. So it really, really depends on what your business is, how much you borrowed, what the terms of the loan are. And yes, it can absorb the first one. We can set up a new loan. It just
Faster, be ready for the next one, or
I guess it's if you have a line available, it's always good to have that cushion, but carry as little debt as possible, I think is the biggest recommendation when first starting off. So you have that in case you need it, but it's not the best option to carry a lot of debt if you don't need to. So paying it down.
But at the end of the day, it's a math problem baked into a strategic plan. So if you're saying, hey, I'm going to refinance this debt because the new rate is a lower rate, and then I'm going to use that amount for this additional capital or improvement plan, they're going to take that into account. And then if it pencils, then you're good to go. All right, guys, thank you so much. We're a little bit over time, so sprint to your next thing. Great job, guys. Yeah, no problem.
Helpful rather than going through each question.